So imagine you're watching a stock you own just completely plummet.
Oh, yeah, the dreaded slow motion crash.
Exactly. Like from a high of over $70 a share, crashing all the way down to 13.
Which is just brutal to watch.
Right. You're looking at your portfolio thinking, okay, well, this thing is completely dead.
Yeah.
But then, almost overnight, this totally unexpected FDA headline hits, and it surges 50% in a single month.
Just out of nowhere.
Yeah, exactly. So the question is, are you looking at a dying trend that's flashing massive sell signals, or are you looking at a fundamentally misunderstood, undervalued buy that everyone else is just completely mispricing?
And I mean, that is the exact dilemma tearing the market apart right now. What you see in that chart entirely depends on how you interpret the underlying mechanics of the whole healthcare industry.
Which is exactly why today we are doing a deep dive into HIMS and HERS Health, ticker symbol HIMS. We're going to tear through their financials, the technical analysis, and this just brutal tug of war between the bulls and the bears.
We really want to figure out what is actually driving this massive volatility.
But before we jump into the numbers, we should probably set some ground rules.
Right, definitely. So just a quick disclaimer for everyone listening. We are here to analyze the data, unpack the market sentiment, all of that good stuff, but we are absolutely not providing financial advice.
Exactly, not financial advice. But if you are enjoying this deep dive, please do us a huge favor. Like the video, subscribe to the YouTube channel, and explicitly, we want you to leave your feedback in the comments.
Yeah, your comments are literally the fuel that keeps these deep dives going.
For sure. So let's get into it. Before we even open up the balance sheet, we need to understand the whiplash of this stock's recent history, right? To see why the market is so incredibly divided.
Right, because context is everything here.
Yeah. So setting the scene, HIMS recently closed at $28.15, which is down nearly 3% on the day. But the wild part is the 52-week range. We're talking a massive high of $70.43 and a low of $13.74.
It is a literal roller coaster.
It really is.
Right.
And to understand that whiplash, we have to talk about that 50% surge in early April. That wasn't just random market noise, right?
No, not at all. That was entirely driven by the FDA, specifically news regarding the FDA peptide rules.
Okay, let's unpack that, because that forced HIMS into a massive business pivot, right? Moving away from compounded GLP-1 weight loss drugs.
Exactly.
What does that actually mean for anyone who doesn't follow pharma regulations?
So think of it kind of like a restaurant. Selling a compounded drug is essentially like making your own generic house cola in the back room.
So?
When major weight loss drugs, the famous GLP-1s like Ozempic or Wegovy, when they went into severe national shortage, the FDA basically said, all right, compounding pharmacies, you can mix your own customized versions of these active ingredients.
Because there literally wasn't enough of the official stuff to go around.
Right. And for companies like HIMS, this was an absolute gold mine. You are sourcing the base ingredients, mixing it yourself, or, through a contracted pharmacy and selling it directly to the consumer.
And I'm guessing the profit margins on that house cola are huge.
Oh, massive. Because you aren't paying a premium to a major pharmaceutical brand.
But the FDA eventually tightens the leash, right?
Exactly. When the official drug shortages end, that regulatory gray area closes. You can't just keep selling the generic house brand if the official stuff is sitting back on the shelves.
Right, so the FDA starts cracking down, and HIMS is certainly forced into a corner.
Yeah, they realized that relying on those compounded GLP-1s was a massive existential risk. The FDA could literally wipe out their primary growth engine with a single memo.
Wow.
So they executed a massive business pivot. They transitioned away from those high-margin compounded drugs and secured official branded partnerships to ensure they actually survive.
Most notably, specifically with Eli Lilly.
Yes, exactly.
So they stopped making the high-margin house cola and started paying the premium to distribute the official Coca-Cola.
That is the perfect way to look at it. It guarantees they stay in business, but the underlying economics completely change.
Which brings us to the core question of this entire deep dive. Is this recent 50% surge actual sustainable momentum? Like, is it real growth because they secured a safe partnership? Or is it just an FDA-induced adrenaline shot that's masking a fundamentally weakened business model?
And to figure that out, we really have to look past the flashy headlines and open the hood, examine the actual financial engine.
Let's do it.
Because the top-line income statement, it tells a story of absolute, undeniable hypergrowth. I mean, if we look at the 2025 annual revenue, they hit an astounding $2.35 billion.
Wow.
Yeah, that is a 59% increase year over year.
A 59% jump at a multi-billion-dollar scale is incredible. Like, it's not like a tiny startup going from 1 million to 2 million.
No, it is rare air for a company of this size. And it wasn't just, empty cash burning revenue. They posted a net income of $128.4 million.
So they proved they could actually turn a real profit.
Exactly. And looking ahead to Q1 of 2026, their guidance is extremely confident. They are pointing to revenue between $600 and $625 million just for the quarter.
Just one quarter.
Right. With adjusted EBITDA sitting between $35 and $55 million.
Okay, let's pause on adjusted EBITDA for a second for anyone who doesn't, live in financial spreadsheets every day. That's essentially their operating profit before the accountants deduct things like interest, taxes, depreciation, right?
Yeah, exactly. It's a measure of the cash the core business is actually generating.
So it shows the core operations are highly lucrative.
Highly lucrative. And for the full year of 2026, they are aiming for $2.7 to $2.9 billion in revenue.
Okay, so those top-line numbers look absolutely fantastic. But here's where I have to push back a little bit.
Go for it.
Because growth is never free, right?
Yeah.
It costs real money to make those numbers go up. If we look at the balance sheet and the actual cash flow, there are some pretty serious red flags.
Oh, absolutely.
For starters, their gross margins dropped from 79% in 2024 down to 74% in 2025. Now, a 5% drop might sound small to some people, but 5% of $2.5 billion is a massive chunk of change.
Over $100 million in profitability just vanished.
Exactly. And that's the exact cost of the pivot we were just talking about, right?
It is. When you partner with a giant like Eli Lilly, you are sharing a much larger piece of the pie. The profit per unit sold naturally compresses.
But wait, I'm a little confused here. If they are partnering with a massive pharmaceutical giant like Lilly, shouldn't their operational costs actually go down?
You'd think so, right?
Yeah, like they don't have to manufacture or compound the drugs themselves anymore. The giant is doing the heavy lifting.
You would think so, but distributing a highly regulated, branded injectable drug is incredibly complex.
How so?
Well, you have cold chain logistics, for one. These drugs often need to be refrigerated during shipping, you have stricter compliance protocols, and most importantly, HIMS had to spend heavily on marketing to re-educate their entire consumer base.
Oh, right. Because they had to say, hey, we aren't just the generic guys anymore. We have the official stuff.
Exactly. And that requires a massive, expensive advertising blitz.
Which perfectly explains why their free cash flow completely plummeted. I mean, it went from over $198 million in 2024 down to just $57.4 million in 2025.
Yeah, that's a huge drop.
Because they are spending heavily on capital expenditures. Warehouses, logistics, ad campaigns.
And that cash burn is basically the price of admission. They are trading short-term profit margins for long-term regulatory safety.
But they are doing it with a pretty heavy debt load, aren't they?
They are.
Like they have $2.2 billion in total assets and about $228.6 million in cash, but they are carrying roughly $1.12 billion in long-term debt.
It is a lot of leverage, no doubt. But management really believes that securing the branded supply chain is the only way to solidify their position in the market long-term.
So if the long-term fundamentals show this massive tension, incredible top-line growth, fighting against shrinking margins and heavy debt, why are people aggressively buying and selling it today? Let's shift our focus to what traders are actually doing on the ground right now.
Let's do it. The daily technicals?
Yeah, the daily trader psychology. Let's look at the technical analysis and the actual order flow.
It's fascinating because the technicals perfectly mirror that fundamental tension we just talked about. Right now, the stock is sitting right around 28 bucks a share. If we look at the RSI, the Relative Strength Index, it's at 42.02.
Let's explain what RSI is actually measuring here. It's basically a speedometer for the stock's price.
Right.
It tells you if the stock is being bought or sold too quickly.
Precisely. It runs on a scale from 0 to 100. If it drops under 30, the stock is considered oversold, meaning it fell too fast and might bounce back.
Right.
And if it goes over 70, it's overbought and might be due for a pullback. So at 42, we are in perfectly neutral to slightly oversold territory. The market is just taking a breath.
Okay, so it's pausing.
Yeah. We also look at the MCD, which tracks the relationship between two moving averages of the stock's price to spot momentum shifts. It recently triggered a bullish crossover.
A bullish crossover.
Yeah, which happens when the shorter-term average crosses above the longer-term average. It suggests that immediate short-term buying pressure is building up.
But the broader moving averages tell a totally conflicting story, don't they?
They really do. The stock at 28 bucks is sitting just above its 50-day simple moving average, or SMA, which is at $27.57.
And in technical analysis, being above the 50-day average is essentially a short-term buy signal, right?
Exactly. It's like the current weather. It means the immediate trend is sunny. But it is still trading well below its 200-day SMA, which is way up at $38.29.
And the 200-day average is more like the macro climate,
Yes. Being below it means the long-term winter isn't over yet. It's a sell signal.
which explains exactly what we were seeing in the order flow. Buyers start crowding in right around that $27 to $28 zone. And that makes perfect sense. It aligns with a strong intraday support level at 27.03, and there is a rock-hard floor down around 24.76. But on the way up, there are massive sell walls starting at 31 bucks.
Right. And for those unfamiliar, a sell wall is when institutional investors park massive blocks of limit orders at a specific price.
Basically saying, if the stock hits $31, automatically sell our shares.
Exactly. It creates a physical barrier that the stock price struggles to break through because there is simply too much supply flooding the market at that exact number.
And that heavy resistance continues all the way up to $35.46.
This is a tough ceiling.
Plus, if you look at the fear and greed score for HIMS right now, it is sitting at exactly 50.
Dead neutral.
It's crazy. It's like a brutal tug-of-war happening in a very narrow claustrophobic hallway between $27 and $31. Nobody can gain an inch.
It really is.
So with the market psychology completely deadlocked at a neutral 50, what is the catalyst? What event finally breaks this stalemate?
Well, the market is currently holding its collective breath for May 11th, 2026.
Earnings report.
Exactly. That is their next earnings report, and it is the ultimate flashpoint. Investors don't want to hear promises about the Eli Lilly partnership anymore. They want mathematical proof,
So that report will either show that the profit margins have stabilized,
which would give buyers the confidence to smash through that $31 sell wall.
right, or it will show continued cash burn, which will shatter the floor at 27.
Exactly.
So because the technicals are perfectly gridlocked until May 11th, let's have a natural debate here to weigh the two extreme scenarios. Is HIMS a fundamentally undervalued gem that Wall Street is mispricing? Or is it a classic value trap designed to catch retail traders?
It's the big debate. Let's start with a bull case.
Oh, hit me.
If you are bullish on HIMS, you are looking at a company that boasts consistent 50+% revenue growth. In a mature market, finding a company at this scale growing that fast is incredibly rare.
Right.
Furthermore, they are highly efficient with the capital they do have. Their return on invested capital, or ROIC, is hovering around 32%.
ROIC is one of those metrics that gets ignored by casual traders,
Yeah.
but is absolutely obsessed over by institutional investors.
Oh, big time.
It basically measures management's efficiency. Like a 32% ROIC means for every single dollar management invests back into the business, whether that's a new warehouse or a marketing campaign, they are generating a 32-cent operating return.
Exactly. It proves they aren't just throwing money into a furnace to buy growth. They are generating real returns. And the business model itself is a high-margin recurring revenue subscription model.
Right, because when you sign up for a healthcare protocol, you tend to stay month after month.
Yeah, the lifetime value of that customer is huge. And they aren't just a men's health company anymore. They are aggressively expanding into massive categories beyond that. Weight loss is the headliner, but they are deeply embedded in hair care, dermatology, and mental health.
So the bulls look at that ecosystem and see a diversified digital health empire in the making. Okay, I see the bull case. The growth and the capital efficiency are definitely real. But I have to push back hard with the downside risks here because the valuation still looks incredibly expensive to me.
Let's hear it.
The PE ratio, the price-to-earnings ratio, is sitting at 54.95,
Yeah, that's high.
with an actual trailing earnings per share over the last year of just 51 cents.
Right, so a PE of almost 55 essentially means investors are willing to pay $55 today for every $1 of profit the company generated over the last year. It is a premium price tag.
Exactly. And you can justify paying a 55 multiple when revenue is growing at 50% a year. But the problem is a valuation that expensive prices in absolute perfection. If that growth rate ever slips, like if it dropped from 50% down below 20%, the market will violently reprice that stock.
Valuation compression is brutal.
And that leads directly into the existential threat of competitive risks. HIMS isn't just competing with scrappy telehealth startups anymore. They are fighting the heavyweights. Amazon is aggressively pushing into the space with Amazon Clinic. Walmart is expanding its digital healthcare footprint.
Yeah, those are terrifying competitors.
Right. Like if you are HIMS and you are carrying $1.12 billion in debt, how do you fight a price war against Amazon? Amazon has virtually infinite capital, and they already have the prime logistics network built out.
It's a massive threat, no question. HIMS's defense relies entirely on their brand loyalty. They have a very slick, integrated user experience that feels premium. It doesn't feel like a sterile hospital visit, you know? It feels like a lifestyle brand.
But is a lifestyle aesthetic really enough of a moat to hold off Amazon's distribution power?
That is the million-dollar question.
Which brings up a very pointed question on behalf of the listeners. We've talked about the constant regulatory risk, the reality that the FDA can change compounding rules overnight and vaporize revenue streams.
Yep.
And when you combine that regulatory risk with the high levels of insider selling we've seen from executives at HIMS over the last year, are retail investors just walking into a trap? Like, when everyday traders buy the dip at 28 bucks, are they just providing exit liquidity for the executives who are quietly cashing out?
That is the defining characteristic of a value trap, and it's really vital to understand how it works mechanically.
Break it down for us.
Well, retail traders often get crushed by volatility in these specific types of stocks because they evaluate the company based on outdated metrics. You see a stock drop from $70 to $28, and your brain automatically registers it as a bargain.
Right, you think it's on sale.
Exactly. But if the regulatory framework that allowed the company to reach $70, like selling high-margin compounded drugs in a gray area, if that no longer exists, then $28 isn't a bargain. It's just the new, permanently altered reality of their business model.
So buying the dip is essentially betting that the old business model will return, which is impossible if the FDA says no.
Precisely. Now, to be fair to management, insider selling is not always a malicious dump. Executives have massive tax bills on their stock options, and they need to diversify their personal wealth.
Sure.
But high volumes of insider selling combined with massive FDA regulatory shifts is a glaring yellow light. It means the people with the absolute most information about the internal margins are taking chips off the table.
Okay, so having laid out the extreme risks and rewards here, how are the professionals actually modeling this? What is Wall Street's short-term versus long-term outlook on where HIMS goes from here?
Well, the analyst ratings reflect the exact same gridlock we see in the technical charts. The average rating right now is a very cautious hold-buy mix. Nobody is entirely willing to pound the table and stake their reputation on it.
And what about the price targets?
Oh, the price targets show massive uncertainty. The average consensus target is around $31.86.
Which, not coincidentally, is right where that massive institutional sell wall is sitting.
Exactly, but the spread between the lowest and highest targets is wild. The lowest target on Wall Street right now is a dismal $18.
Ouch.
Yeah, predicting a return to the absolute depths. But the highest target is an incredibly optimistic $68.
Wait, really? An $18 to $68 spread on a stock currently trading at 28 bucks? That's insane.
Yeah.
It basically means the professional analysts literally have no idea what is going to happen.
It means the outcomes are binary. There is no middle ground here. So if we synthesize the timelines for the listener, here's how you should think about it.
Yeah.
In the short term, expect intense chaos and volatility. The market is firmly in a show-me state. They are waiting for concrete proof that the pivot to Eli Lilly won't permanently destroy their profit margins.
And long term.
Long term, the outlook remains fundamentally bullish, but only if their core subscription growth holds steady and only if the execution of the Eli Lilly partnership is flawless.
So wrapping up this conversation, it's clear that HIMS is the ultimate battleground stock in the market right now. It is a spectacular clash between undeniable hypergrowth and terrifying regulatory and margin cliffs.
They've proven they can grow. Now they have to prove they can survive the regulations.
Which leaves us with a final provocative thought for you to mull over. HIMS was forced to move away from highly profitable compounded GLP-1s to safer branded partnerships just to survive the FDA. But you really have to wonder, will the very pivot that ensures their survival be the exact thing that ultimately destroys their profit margins?
It's entirely possible the cure is worse than the disease.
Exactly. We want to know what you think. If you found value in this breakdown, hit that like button, subscribe, and drop your own theories on HIMS down in the YouTube comments section. Is it an undervalued gem or a value trap? Let us know, and we'll catch you in the next deep dive.